morning. Welcome back to the Forex Lounge Fundamentals. Today is Tuesday, April 20th, 2010. Welcome back, one and all. Great you could join us. Today, Bloomberg.com reports Canada's dollar climbed the most since January as the central bank said it will start raising interest rates because of faster than expected economic growth and inflation. The Canadian dollar strengthened through parity with its U.S. counterpart as the central bank kept its lending rate at a record low 0.25%. while dropping a pledge to hold it there through June. The currency traded on a one-for-one basis with the greenback on April 6 for the first time since July 2008 on speculation rates will rise faster in Canada than in the U.S. Getting to the charts, the blue line represents the interest rate in Canada left unchanged at 0.25%. The violet line represents a 12-month average, and we can see the 12-month average has now dipped down to virtually where we are now because the Bank of Canada has not changed rates since they last cut back in April of 2009. Moving forward now, we see the Bank of Canada, again, the interest rates kept at 0.25% by the blue line at the bottom. The TSX at Toronto Exchange at the top shows a pretty strong positive correlation. As the Bank of Canada historically has raised rates in light of a stronger economy, well, this also is reflected by the Toronto Stock Exchange Index, which has also gone up. As the economy has weakened over the past couple of years, Bank of Canada has cut rates, and so has the Toronto Stock Exchange gone down. Now that we see the Bank of Canada not raising rates, but maybe anticipating a rate hike soon, we certainly would anticipate the TSX to continue to rise. Comparing now the Bank of Canada interest rates again with the blue line and the dollar-CAD currency pair. Now, it's not a complete fair comparison because there are two currencies within the dollar-CAD pair, the dollar and the CAD. However, there is a pretty strong inverse or opposite correlation, meaning when the Bank of Canada raises rates, the dollar-CAD tends to go down because the Canadian dollar is the second currency within that pair. And when the Bank of Canada has cut rates, the dollar-CAD has gone up. Now comparing the dollar-CAD currency pair to the Toronto Stock Exchange, the dollar-CAD is a blue line, the violet line represents the Toronto Stock Exchange, and we can see also a pretty strong inverse or opposite correlation. Dollar-CAD goes down, the TSX goes up. As the TSX goes up, the dollar-CAD would go down. So if we anticipate the Bank of Canada to raise rates, if we anticipate the Canadian economy to continue to strengthen, if we expect the TSX to go up, logically we'd expect the dollar-CAD to go down, or at least the Canadian dollar to strengthen against most other currencies. With that said, if you have any questions, do not hesitate. Email us anytime, info@forexlounge.com. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside the Forex Lounge.